I'm with Deputy Fund Manager of the Courtiers Multi-Asset Funds, James Timpson. James, hi. How's January been and how's 2023 kicked off?
Well, Leo, after the doom and gloom of 2022, in which equity markets had their worst year since the global financial crisis, the good news is they've bounced back so far this year. So with inflation starting to drop back a bit, in the UK, it went down from its 40-year high to around 10.5% at the moment. And in the US, it's fallen below 7% for the first time in over a year. And because of this, there are hopes and expectations that central banks will ease off on all of the rate hikes that they've been engaging in over the last year. And this has led to some optimism in the stock market. So the FTSE 100 index, for example, that's risen more than 4% in the last month. The S&P 500 index, which tracks US stocks, that's up more than 6%. And it's been a particularly good month for European equities. So the Euro Stocks index has risen nearly 10% in the last month. So it's just had its best January on record. There's also been a bit of a recovery in the bond market as well. So the bond yields have fallen and the 10-year gilt yield fell from around 3.7% to around 3.3% by the end of January. So there's been a lot more optimism all round.
Are you expecting these trends to continue?
Well, interestingly, we have a Bank of England rate decision today. So by the time this video comes out, you'll know for sure what's happened. But the strong expectation is that the Bank of England is going to increase rates again. This will be the 10th rate rise in 14 months. It's expected to rise to around 4%. But the market will already be expecting this, which is why we've still seen plenty of optimism lately. The market's already priced in the expected rate hikes. So there's no reason why there can't be continued cautious optimism.
Thanks, James. Now, just wondering really, towards the back end of 2022, if there was any investment decisions you might have made regarding specific stocks. Basically, any decisions you made through last year, towards late last year, are any of those starting to come to fruition of sorts with this positivity that we're seeing, or is it too early to tell?
I mean, one of the things we have been doing in the last couple of months, now that interest rates are returning more towards their long-term average levels, we have been building duration or interest rate risk back into the funds, in particular the cautious risk fund, which is meant to have the most fixed income exposure. So because we were short duration going into last year, we weren't too heavily impacted by that huge decline in the bond market. But now that rates are at much more typical levels, we have been building back fixed income exposure. So if rates are to start falling back, having risen so much last year, then we will pick up some of the rise in the bond market. But we're not expecting any significant move either way. We're simply making our position in fixed income more neutral.
Sure, so you're still operating defensively?
Overall, yes, we are still defensive. We don't foresee a significant decline in interest rates in the near future, so we're not going too heavy on duration, but we are just gradually building that position back up.
James, thanks very much for your time. I will look forward to catching up with you next month.